What do you think happens to the global economy if a single narrow waterway suddenly becomes unstable? Do you believe markets are prepared for that possibility, or are investors once again underestimating the kind of shock that can move commodities overnight? I want you to think about that question carefully because something important just happened in the silver market, and the timing is not random. Silver just slipped below one of the most watched technical levels in commodities trading, the 50-day moving average, falling 2.7% in a single trading session. The spot price is currently sitting near $24.18, and earlier during the session, the price briefly touched around $24.05 before stabilizing slightly. On the surface, that kind of move may look like normal market volatility, something traders see every week, but the underlying data tells a more serious story. Trading volume surged roughly 15% above the average daily level, and that matters because volume reveals conviction. When prices drift lower on thin trading, it usually means the move lacks strength. But when price breaks an important technical level and the number of contracts traded jumps sharply, it signals that large sellers are actively pushing the market. That is exactly what happened here. Sellers arrived with size and pushed silver through the 50-day moving average, a level that virtually every algorithmic trading system monitors. This indicator is not just another random line on a chart. In commodity markets, it acts like a trigger point that many automated models respond to instantly. When the price moves above it, some algorithms begin buying. When the price drops below it, those same systems flip to selling. That means a break of this level can create a cascade of additional selling pressure because computers across global trading desks react within milliseconds. Silver sliced through that level decisively, and that is why this session deserves closer examination. What we need to understand is what caused the move, what forces are pushing behind it, and why the story surrounding silver right now could be much bigger than a simple price drop. To understand today's movement, you have to look at several different forces that are converging at the same time. None of them exist in isolation. When they combine, they create the type of environment where prices can move quickly in one direction. The first force is the US dollar. During the same trading session when silver declined, the dollar index strengthened noticeably. This relationship is extremely important because silver is priced globally in US dollars. When the dollar rises in value relative to other currencies, it naturally places downward pressure on commodities that are priced in dollars. The reason is mechanical and straightforward. If the dollar becomes stronger, it requires fewer dollars to purchase the same ounce of silver. That mathematical relationship alone can push the price down. But there is another layer to it that many casual observers miss. When the dollar becomes stronger, silver becomes more expensive for buyers using other currencies. A manufacturer in Germany purchasing silver for electronic components must convert euros into dollars before making that purchase. If the dollar strengthens, the cost measured in euros rises. The same dynamic applies to a solar manufacturer in China buying silver for photovoltaic cells or an electronics producer in Japan using silver for advanced circuitry. A stronger dollar effectively raises the price for international buyers, which can temporarily suppress demand at the margin. Even a small slowdown in international buying can tip the balance between buyers and sellers in the short term, and that appears to have contributed to the pressure on silver today. The second force behind this move is monetary policy expectations. Central bank communication has continued to push back against the idea that interest rates will fall quickly. When markets anticipate rate cuts and then central banks signal that rates may remain elevated longer, financial conditions tighten almost immediately. Real interest rates, meaning rates adjusted for inflation, become especially important in this context. Silver, unlike bonds, does not generate yield. If interest-bearing assets such as treasury bonds offer 4 or 5% returns, some institutional investors choose to allocate capital there rather than hold metals that provide no income while they wait for price appreciation. For large asset managers who must justify decisions to committees and boards, those yield comparisons matter. This shift in expectations about interest rates has therefore created short-term pressure on precious metals, including silver. It does not necessarily mean the long-term outlook has changed, but it can certainly influence the price behavior from one session to the next. The third force is related to industrial demand, and this is where silver differs significantly from gold. More than half of global silver demand comes from industrial applications. Silver is used in solar panels, electric vehicles, semiconductors, medical devices, and countless electronic components that power modern technology. It is one of the most conductive metals known, making it essential for high-performance electrical systems. However, recent manufacturing data from major industrial economies has raised concerns. Purchasing Managers Index readings from both China and Germany, two of the world's most important manufacturing hubs, have recently indicated contraction rather than expansion. In PMI data, any reading below 50 signals that manufacturing activity is shrinking. When factories slow production, they tend to delay purchasing raw materials. Instead of ordering new supplies immediately, they draw down existing inventories and wait for better pricing or stronger demand signals. Even if this slowdown is temporary, it can create a short-term demand gap that traders in the futures market react to quickly. The fourth force involves inventory levels. Reports from major storage facilities connected to futures markets showed a modest increase in registered silver stocks during the same period. When more silver is sitting in vaults that are designated as deliverable against futures contracts, it suggests that supply available to the market has increased slightly. For traders who closely watch the physical side of the market, this kind of inventory build can remove some of the urgency that previously existed when stocks were declining. When inventories are falling, it implies that demand is absorbing supply faster than it can be replenished. That situation tends to support higher prices because short sellers become nervous about securing metal for delivery. When inventories rise, that pressure temporarily eases. The final force influencing the market right now is competition from alternative assets. Capital has recently been flowing toward digital assets again, particularly cryptocurrencies. When those markets attract excitement and momentum, some speculative capital shifts away from commodities and precious metals. Silver and cryptocurrencies serve very different roles in portfolios, but they do compete for a portion of the same investment capital. Investors searching for inflation protection or alternative stores of value sometimes move between these markets depending on which one appears to be gaining momentum. At the same time, the broader geopolitical environment cannot be ignored. Global supply chains still depend heavily on energy shipments moving through critical routes such as the Strait of Hormuz. Any instability in that region has the potential to influence commodity markets, energy prices, and investor behavior worldwide. When geopolitical tension rises around such strategic choke points, markets often react quickly because energy flows, shipping routes, and economic stability are interconnected. For metals like silver that already sit at the intersection of industrial demand and financial investment, geopolitical uncertainty can amplify both fear and opportunity in the market. All of these factors together create a complex picture. On the surface, silver breaking below the 50-day moving average appears bearish. The stronger dollar, elevated interest rate expectations, weak manufacturing data, a small build in inventories, and capital competition from cryptocurrencies all point toward short-term pressure. But understanding silver requires looking beyond daily fluctuations. Beneath the short-term noise lies a much larger structural story involving supply constraints, industrial demand growth, and global economic transformation. And once you start examining that deeper data, the conversation around silver becomes far more interesting than the headline price movement alone. Now, we need to step back and examine the deeper layer beneath the daily volatility because what you saw in the last session is only one piece of a much larger puzzle. Short-term price movements often dominate headlines, but commodities like silver operate within long structural cycles that unfold over years, sometimes decades. When you focus only on daily price action, it becomes easy to miss the underlying forces quietly reshaping supply and demand. And in the case of silver, those structural forces are extremely important right now. One of the most misunderstood aspects of the silver market is how supply actually works. Unlike gold, which is often mined as a primary product, a large portion of global silver production comes as a byproduct of mining for other metals. Copper, lead, and zinc mines account for a significant share of annual silver output. This creates a situation where the amount of silver produced each year is not determined purely by silver demand. Instead, it is heavily influenced by the economics of other metals. When copper or zinc mining slows because of economic conditions or declining ore grades, silver production can decline even if silver demand remains strong. That dynamic limits how quickly supply can respond to rising demand. If silver demand suddenly surges, mining companies cannot simply open dozens of new silver mines overnight. New mining projects require years of exploration, permitting, financing, and construction. In many cases, the timeline from discovery to production can take 7 to 15 years. Environmental regulations, infrastructure requirements, and capital investment all slow the process. As a result, the silver supply pipeline moves slowly compared with the pace of demand growth. Another issue affecting supply is declining ore quality. Over decades of mining, many of the highest grade deposits have already been extracted. What remains often requires deeper excavation and more complex processing. Lower grades mean more rock must be mined and processed to produce the same amount of metal, which increases cost and slows production growth. Major producing countries such as Mexico, China, and Peru have experienced periods where output fluctuates because of these geological and economic challenges. When analysts look at the broader supply picture, the data suggests that global silver demand has exceeded newly mined supply in several recent years. This creates what is known as a structural deficit. In other words, the world is consuming more silver annually than mines are producing, forcing the market to draw from existing above-ground inventories. These inventories include silver stored in vaults, held by investors, or contained within industrial supply chains. Over time, persistent deficits gradually reduce those reserves. At the same time, supply growth faces constraints. Demand continues to expand in several important industries. Solar energy is one of the largest contributors to silver consumption. Photovoltaic panels rely on silver because of its exceptional electrical conductivity. As countries accelerate their transition toward renewable energy, the number of solar installations continues to rise rapidly. Governments across multiple regions have committed enormous investment toward expanding solar capacity. That means millions of additional panels will be produced, each requiring small but significant amounts of silver. Electric vehicles represent another growing source of demand. Modern vehicles contain numerous electrical systems, sensors, and power management components that rely on conductive metals. Silver is widely used in electrical contacts and specialized circuitry. Electric vehicles typically require more silver than traditional combustion vehicles because of their advanced electronics and battery systems. As global transportation gradually shifts toward electrification, that demand channel continues expanding. Electronics manufacturing adds another layer to the story. Smartphones, computers, networking equipment, and advanced semiconductors all incorporate silver within their internal architecture. Data centers powering artificial intelligence systems require massive quantities of electronic hardware, and each of those systems relies on high-performance materials. Even medical technologies, from diagnostic equipment to antimicrobial coatings, depend on silver's unique properties. This is not speculative demand driven by investor sentiment. It is structural demand embedded in the technological infrastructure of the modern economy. When you combine these demand drivers with constrained supply, you begin to understand why many analysts discuss the possibility of significantly higher silver prices over the long term. The argument is not based on hype or internet speculation. It is built on basic arithmetic. If annual consumption continues exceeding production while industrial demand grows, the balance between supply and demand eventually tightens. Markets tend to adjust prices to reflect that imbalance. However, financial markets do not move in straight lines. Even in environments where long-term fundamentals appear strong, short-term forces can dominate for weeks or months at a time. Currency fluctuations, interest rate expectations, and macroeconomic headlines all influence trader behavior. That is exactly what we are witnessing in the current environment. Another important factor to consider is the distinction between paper markets and physical markets. The price quoted on financial screens usually represents futures contracts traded on exchanges. These contracts allow traders to speculate on the future price of silver without necessarily taking physical delivery of the metal. The volume of these derivatives can be enormous compared with the amount of physical silver that actually changes hands. Physical silver markets operate differently. When investors or industries require real metal, they purchase coins, bars, or industrial supply directly from dealers and refiners. In periods of strong demand, premiums on physical products often rise above the quoted futures price. These premiums reflect fabrication costs, transportation, and sometimes scarcity in the supply chain. When investors grow concerned about financial instability, many prefer holding physical metal rather than financial contracts that depend on counterparties. This distinction between paper and physical markets becomes especially relevant during periods of economic uncertainty. Investors seeking tangible assets often shift toward bullion ownership. Physical metal stored privately carries no issuer liability and cannot be defaulted upon in the same way financial instruments can. For some investors, that characteristic alone makes precious metals appealing during volatile economic cycles. The broader precious metals environment also includes gold, which tends to move alongside silver over longer time horizons. Central banks around the world have been accumulating gold reserves at historically elevated levels in recent years. Countries including China, India, Turkey, and others have increased purchases as part of strategies to diversify national reserves. These purchases represent strategic decisions by sovereign institutions that manage national wealth. When central banks allocate more reserves toward gold, rather than foreign currencies or government bonds, it sends a signal about how they perceive global financial stability. Precious metals historically function as stores of value during periods when confidence in fiat currencies weakens. While silver does not play the same role in official reserves as gold, it often benefits from the broader investment trends that influence the precious metals sector. Another relationship closely watched by analysts is the gold-to-silver ratio. This metric measures how many ounces of silver are required to equal the price of 1 ounce of gold. Historically, during strong precious metals bull markets, this ratio tends to decline because silver prices rise faster than gold. When the ratio remains elevated, it sometimes suggests that silver has room to catch up relative to gold. While these structural trends support long-term optimism among many investors, the short-term outlook remains influenced by the same factors discussed earlier. Currency strength, interest rates, manufacturing activity, and speculative capital flows all shape market behavior from one trading session to the next. The silver market therefore sits at an intersection where industrial demand, financial investment, and macroeconomic forces constantly interact. There is also an external variable that could influence commodities broadly: geopolitical tension surrounding critical trade routes. Energy shipments moving through narrow maritime corridors like the Strait of Hormuz represent a lifeline for the global economy. If tensions rise in that region, energy prices could respond quickly, affecting transportation costs, manufacturing expenses, and inflation expectations worldwide. Commodity markets historically react strongly to disruptions in energy supply because energy forms the foundation of industrial production. If shipping routes or energy flows were disrupted, the ripple effects could move rapidly through financial markets. Higher energy prices often increase production costs for many industries, which can influence inflation and central bank policy decisions. Precious metals frequently respond to such macroeconomic shifts because they are viewed as alternative stores of value when uncertainty rises. All of these layers create a complicated landscape for silver investors. Short-term signals may appear bearish when technical levels break and macroeconomic pressures build. Yet the deeper structural picture suggests that silver continues to play a critical role in the evolving global economy. The interaction between those two timelines, short-term volatility and long-term fundamentals, will likely determine how the market behaves in the coming months. Now that we have examined both the short-term pressures and the deeper structural forces shaping the silver market, the most important question becomes timing. Markets rarely move in a straight direction, and commodities are especially sensitive to waves of sentiment, liquidity shifts, and macroeconomic headlines. The break below the 50-day moving average created a technical signal that many traders interpret as bearish in the near term. When such a widely followed indicator fails on elevated volume, automated trading systems often amplify the move. That is because algorithmic models are programmed to react instantly to technical triggers. Once that level is breached, additional sell orders appear almost automatically, which can push prices further than the original shift in fundamentals might justify. The next level traders are watching closely sits near $23.80. That area represents a previous swing low and also aligns with a key Fibonacci retracement level from the earlier rally. In technical analysis, Fibonacci retracements often act as areas where buyers attempt to defend price during corrections. If silver stabilizes around that region, the decline could simply represent a normal pullback within a broader upward trend. Corrections are a natural part of any market cycle. Even the strongest bull markets include periodic declines as traders take profits and weaker hands exit positions. However, if selling pressure intensifies and that support fails decisively, traders could begin looking toward the psychological $23 level as the next area of interest. Psychological price points matter because many investors anchor expectations around round numbers. When markets approach those levels, trading activity often increases. If a breakdown occurs, it can trigger additional technical selling before buyers step back into the market. Resistance levels are equally important in determining whether the market regains momentum. If silver rebounds, traders will likely watch the region around 24.50, which previously acted as support before the breakdown. In technical terms, former support often becomes resistance once price moves below it. If silver manages to reclaim that zone and hold above the 50-day moving average again, it would weaken the bearish signal created by the initial breakdown. Until that happens, short-term momentum indicators may continue favoring sellers. To understand how the next phase could unfold, it is useful to consider two broad scenarios. The first scenario is bearish in the short term. In this outcome, the US dollar continues strengthening as interest rate expectations remain elevated. Manufacturing activity stays weak across major industrial economies, reinforcing concerns about near-term industrial demand. Inventory levels continue rising slightly, removing urgency from buyers in the physical market. At the same time, speculative capital flows toward alternative assets such as cryptocurrencies or equities instead of precious metals. If those forces persist together, silver could test lower support levels before stabilizing. Another element in this bearish scenario involves broader market stress. When financial markets experience rapid declines, investors sometimes sell even strong assets to raise cash. This phenomenon is known as liquidity-driven selling. During such phases, margin calls force traders to close positions regardless of long-term fundamentals. Silver, being a highly liquid commodity, can become part of that selling wave even if its underlying outlook remains positive. In other words, the price movement may reflect financial mechanics rather than fundamental weakness. The second scenario is more constructive for silver. In this outcome, the support around 2380 holds and attracts buyers who view the decline as an opportunity. Technical traders step in near the Fibonacci level, and selling pressure gradually fades once algorithmic liquidation runs its course. At the same time, the structural drivers of silver demand continue strengthening. Renewable energy expansion remains a priority for governments around the world, ensuring ongoing growth in solar installations. Electric vehicle adoption continues expanding as technology advances and infrastructure improves. If industrial demand remains resilient while supply growth remains constrained, the long-term supply deficit narrative could become more visible to investors. That kind of realization often leads to renewed interest from institutional funds that previously overlooked the market. Precious metals cycles sometimes develop slowly and then accelerate once capital begins flowing toward the sector. Another supportive factor could emerge from monetary policy shifts. If economic conditions weaken enough to prompt central banks to reduce interest rates, the opportunity cost of holding non-yielding assets like silver would decline. Lower real interest rates historically support precious metals because they reduce the advantage of holding yield-bearing assets. At the same time, if inflation expectations remain elevated, investors may seek assets that preserve purchasing power over long periods. Currency dynamics could also play a significant role. The strength of the US dollar has been an important driver of commodity prices. However, maintaining a strong currency while running persistent fiscal deficits is challenging over extended periods. If markets begin questioning the sustainability of government debt trajectories, currency values can shift rapidly. A weaker dollar generally supports higher commodity prices because commodities become cheaper for international buyers. Beyond economic variables, geopolitical developments remain an unpredictable but powerful influence. Global trade depends on stable shipping routes, particularly for energy supplies moving through narrow maritime corridors. The Strait of Hormuz is one of the most strategically significant choke points in the world. A substantial portion of global oil shipments travels through that narrow passage connecting the Persian Gulf to international markets. Any escalation of tension in that region has the potential to disrupt energy flows. If such disruptions occur, energy prices could rise quickly. Higher energy costs influence nearly every part of the global economy because transportation, manufacturing, and agriculture all depend on fuel. Rising energy prices can therefore push inflation higher and create economic uncertainty. During periods of geopolitical stress and inflation concerns, investors often shift toward assets perceived as stores of value. Precious metals historically benefit from those conditions. Silver tends to follow gold during periods of geopolitical risk, although it often moves with greater volatility. When safe haven demand increases, gold typically reacts first because of its long-standing role in global financial systems. Once momentum builds, silver frequently accelerates more rapidly because its market size is smaller and therefore more sensitive to capital flows. For long-term holders who accumulate physical silver gradually over years, short-term fluctuations rarely alter the fundamental thesis. The core argument for silver rests on three pillars: constrained supply, expanding industrial demand, and the evolving role of precious metals within the global financial system. None of those factors change significantly during a single trading session, or even over several weeks of volatility. Investors who approach silver with a long-term perspective generally focus less on daily price movements and more on the broader structural trajectory. That does not mean volatility should be ignored. Understanding price swings helps investors manage risk and avoid emotional decision-making. Markets often attempt to shake out weaker participants during periods of uncertainty. Maintaining discipline during those phases can be challenging, but also essential. For those newer to the silver market, the most important step is clarity about time horizon and strategy. Trading short-term price movements requires different tools and risk management than long-term investment. Traders focusing on daily charts often use stop losses and precise position sizing to protect capital during unexpected moves. Long-term investors typically focus on gradual accumulation and diversification rather than frequent trading decisions. Regardless of strategy, emotional reactions often create the largest mistakes in volatile markets. Fear during declines can push investors to sell near lows, while excitement during rallies can encourage buying near peaks. Developing a structured plan before entering any position helps reduce the influence of those emotional cycles. What makes the current moment particularly interesting for silver is the contrast between short-term signals and long-term fundamentals. On one side, technical indicators and macroeconomic conditions currently lean toward caution. On the other side, structural demand drivers tied to technology, energy transition, and industrial development continue strengthening. Eventually, markets reconcile those opposing forces, but the timing of that reconciliation is never perfectly predictable. The coming sessions around key technical levels will provide valuable clues about how the next phase may unfold. If buyers defend support and momentum returns, the recent decline could become a temporary correction within a larger upward trend. If support fails, the market may need more time to consolidate before the structural story reasserts itself. In the end, silver occupies a unique position among global commodities. It functions simultaneously as an industrial metal and a monetary metal. That dual identity means it reacts not only to manufacturing activity but also to financial conditions and geopolitical developments. Few assets sit at the intersection of so many powerful forces. For that reason, movements in silver often reveal broader signals about the global economy itself. When supply constraints, technological demand, monetary policy, and geopolitical uncertainty converge, markets can shift rapidly. Whether the next major move arrives sooner or later, the fundamental dynamics shaping silver remain deeply connected to the direction of energy markets, technological infrastructure, and the stability of the international financial system.